The year is 1998. The hedge fund, Tiger Management, has over $22 billion in assets under its management. To put that into perspective, that is the same as the GDP of the entire country of Laos. Tiger Management was led by Julian Robertson, who was a former US Navy officer and by then a stockbroker. It was the second largest hedge fund in the world at its peak. From the 18 years from the hedge fund's inception in 1980 up until 98, Tiger Management returned an average of 32% per year after fees for its clients. That's nearly triple the average return the S&P 500 provided during the same period. Robertson was an avid value investor. Value investing involves investing in undervalued companies. It is a strategy employed and popularized by Warren Buffett and his hedge fund, Berkshire Hathaway. On the other hand, for Robertson, at Tiger Management, he made bets shorting companies that he believed were overvalued, which in the late 90s amid the dot-com bubble were plentiful. This is a very intelligent strategy. The only problem was that in 1998, the bull market was a couple years away from being over. The overvalued stocks he shorted continued to soar until 2000. Tiger Management was forced to buy back these stocks that he shorted at a much higher price than he sold them for, resulting in massive losses. On top of that, US Airways, which some of you youngsters may not have heard of, accounted for 25% of Tiger Capital Management's holdings. Robertson also saw US Airways as an undervalued airline that was trading far below its all-time high price. But contrary to his prediction, US Airways was headed towards bankruptcy. These bad bets caused Robertson to close down Tiger Management in March of 2000, which was the same month the dot-com bubble finally burst. Unfortunately, it was already too late. As he retired, his contemporaries saw Robertson, once the Wizard of Wall Street, as washed up. He always had a sixth sense for seeing overvalued assets. In 2007, just like Michael Burry, he made another big bet against mortgage-backed securities. Robertson bought up credit default swaps on subprime debt. Credit default swaps only pay out when the borrower on a mortgage defaults on the loan. When the subprime debt bubble inevitably collapsed in 2007, he made huge gains. It was reported that in those 7 years since he closed his hedge fund, he made a 400% profit on his personal $1 billion in capital. The few years that his fund performed badly in the late 90s now just look like a minor slump. Thanks for watching, guys, and if you want to hear some more finance stories, just click the button down below, subscribe, and stay tuned for more. I'm gonna have more of these coming every week.